was part of California.
And that your office over there?
No, out of Florida.
Okay. So, okay, so, but new to being an agent, your own agent. So everybody except for Catherine, you've been in a little bit longer than a year. Okay, and then Steph, you've been a little.
Yes, year 2.
You're on your, I knew you've been in a year.
Yep. This is new, yeah.
Yeah, your color.
Yeah, it's my kids' faces. We look for the close. Their profiles are embedded into the stems.
Oh my gosh, I thought it was just flowers.
Yeah,
Wow, that's
they each have their own flower, and
wow.
don't always got them.
Very, very cool. So for you, for the last, we have some folks that have been here for a few years, 10 almost, I guess 8, and some 2 years, 1 year. The market has been really unusual. I could say this because I've been in the business for 40 years. Since COVID, the market has not been a normal market, what we might say normal. And I'm only judging that against the previous 35 years of my career. But if you're just in the business in the last year or two, this is normal because it's what we have and it's what you've been working, right? We will see, and Keller Williams talks a lot about shifts in markets and things like that. We will see a shift and the market will normalize at some point where we have more inventory. So buyers and actually have choices, and the market shifts a little bit from a seller controlled transaction, which right now the seller calls, they're getting 3 or 4 offers on a home. They're calling the shots. So the buyers really just, have a hope and a prayer of having a good offer accepted. But the seller gets to choose which offer, they are accepting. In a more normalized market, you might have a house be on the market for 45 or 60 days. And prior to 2020, about 45% of my business was government loans. Okay. There is a need for government loans. Not everybody qualifies for the conventional loan. And there's many little bennies that, most buyers aren't aware of, most realtors aren't aware of them because you haven't been able to get offers accepted with anything other than conventional, it seems like, for the last 4 or 5 years. This spring, earlier in the spring, I guess we're summer now, I did see more FHA deals being accepted and a couple VA deals being accepted. So I think some of that shift may have already started. But if you were buying a house in February or March, there wasn't as much competition as there is right now that we're in the prime selling season. When the market does shift and houses are on the market for, not 75, 90 days, which isn't unusual if you look at, the history of how long it takes to sell homes, you're going to find that you're going to be able to get more government offers accepted. So you need to have a knowledge of these government programs as part of your toolkit to sell homes. There are a lot of really good conventional programs like right now that give closing cost assistance and that type of thing because there was a need. The sellers weren't accepting FHA offers. So, how do we get people into homes? Well, they became creative with conventional loans that maybe we can give some lender credit or send them to PHFA and get some assistance from the state, that kind of thing. But eventually we are going to see a large portion of our business revert to the government loans, being common and not, it seems like almost sellers are afraid of them. Like why, you present an FHA offer and they're like, oh, why is that FHA? I better go with conventional. Do you guys know what's a seller's fear? Why are FHA and VA offers not really being considered the same as a conventional? Do you guys know why?
The inspections that need to be done.
Exactly. Because government loans have always required that the appraisal be done for 2 reasons. On a conventional loan, an appraisal is done for 1 reason, to show that there's enough collateral for the loan. The appraisal is done for the mortgage company, not for the buyer. We want to make sure there's enough collateral. Appraisal is done. A government appraisal has 2 objectives. The first is to show there's enough collateral for the loan, the same as a conventional loan. The second is to make sure that the house meets minimum property standards. Okay. Those minimum property standards, you might have heard about them over, your time in, that you've been in business. Who knows what some of those things that the FHA looks for in appraisals? Anybody have any ideas? Just shout them out if you know. The things that FHA cares about.
Roof, basement.
Okay,
electrical.
so let's stop right there. Roof. Roof has to have at least a 2-year life on it. That doesn't seem like that much, does it? But if they call out the roof, if the appraiser says, hey, there's some shingles that look like they're peeling, you need to get a certification that says the roof has a minimum 2-year life. Okay, what was your next one? You said basement.
Basement,
What's wrong if there's a basement? What would they call out on a basement?
wet water or structurally unsound.
Both, right? So structurally unsound is a big problem, and that could be called out on conventional, by the way, because structurally unsound means the house could fall down, and do we really want to be involved in that? You're always going to have to get more information if that comes up, regardless of what type of loan it is, just FYI. But the wet basement, absolutely, you'll have to make sure that there's not, a problem. Did you get it up?
We're only getting it up yours. We just have to save it as a
Okay.
PowerPoint, email it to me, and I can.
Okay, you can get up. So I'll just continue to talk. That's okay. I'll do it off the top of my head, Mike, don't worry.
That's why I keep you around.
So, wet basement, for sure. That's, we want to make sure there's not mold, and those type of things. They're health and safety issues that the government cares about. They're not necessarily construction, issues like, was the house built well? Are the walls flimsy? That they don't care about. It's health and safety issues. So basement, we got roof, we got basement. What else? What else was out there that they care about?
Chipping paint,
What's that stuff?
chipping.
Peeling paint.
Chipping paint,
Has always,
handrails.
let's stop at peeling paint. Peeling paint has been a huge issue for government loans for a long time, because you can have a beautiful house and just have a window with some trim that's peeling, and they scrape and paint, and you're like, scrape and paint. So recently, just this year, there have been some changes that the government has made to the appraisal requirements, and they are doing away with this peeling paint requirement.
For FHA as well. I heard about VA, but.
Yes, it's supposed to be for both. Okay, VA has already happened. FHA is in the works. I don't know what the date is or anything like that, but it's supposed to be a government loan thing that they're making it easier. So I'll let you know now, but that is supposed to be something that goes away. Now, somebody said peeling paint right after that. You said something else.
Handrails,
Handrails.
3 steps,
Two, if you have
more than 2.
more, yes, more than 2. You can have 2, but more than 2, you need a handrail. So I have been in a home in Oberlin that the stairway to go upstairs was this big. And I'm a big girl, but I had to walk sideways to go up. And if they put a handrail there, there was no way, but they had to put a handrail there because that was a requirement. That handrail was coming down after closing, but it doesn't matter. Nobody comes in after closing and inspects to say, is that handrail still there? There also is requirements for handrails if you have what the appraiser considers a dangerous situation with a driveway. You ever see a house that's built up a little bit and the driveway's down here? You have to walk up some steps to get to the front door. I have had on numerous appraisals, 2 specific, one with Becker, it's his listing. They made them put a fence along the hill so nobody would fall over into the driveway. Okay, that was a health and safety issue, kind of like handrails. So those things are the reasons that sellers have pretty much said, yeah, I'm just don't want to deal with these little things. Even if it's a handrail, why should I spend $150 for a handrail? I don't have to. Well, if a seller gets an offer on his $250,000 listing at $255 and it's an FHA, and the conventional is $248, why not accept the offer that's going to give them more money? Because you as the agent can tell them what needs to be done to make sure it passes appraisal. Okay, they can end up with $10,000 more net proceeds and pay $150 to do a handrail. is that not the better deal for the seller? You know, to me, it's almost ridiculous that, I get it, when you have 12 offers, you take the easy road. But when the market starts shifting, there is nothing wrong with people who take an FHA mortgage. I bought my first house with FHA, and it's almost become like, oh, FHA, there's something, you know, maybe their credit's bad. I have a girl right now who's working with Erin, and she has an 8 or 9 credit score, and we're going FHA because there's benefits to FHA. Okay, so don't discount these programs. There's a lot of value for them, and what we're going to do is Mike's going to go through them and talk a little bit about each one. And we're gonna get pizza coming in at some point, okay? So then we'll just have that, we'll eat and talk at the same time. But anybody have any questions? This is not formal, just, you know, you don't have, just let us know what the questions are. Mike's going to email this.
Yes, I was gonna try to get a sign-in sheet, but I'll do that before everyone leaves. Emails, all that, and then this presentation will go to everybody. And then I also have some flyers that'll also have additional information that will go with it as well.
And there are some things that you'll want to take some notes on, because we have a spot where we just have like open conversation kind of thing. And you can, you know, tie that to when you get your email later.
Yeah.
Am I in the way?
Nope, you're good. I think there's plenty of screens. There's 4.
Okay.
Everyone's seeing these screens.
Yeah.
Oh, you got it on all 4?
One of the things that I felt was most important with this class was what she kind of wrapped up on was, say you're the listing agent and you have to dissect these deals and what is going to get your seller the most amount of money. Knowing these things and going to the property when you have that listing appointment, assessing the property, looking through it and saying, these things are would be identified on a government loan. If we want to cast a bigger net to get more offers, maybe a higher purchase price, you'll want to identify those things. And a lot of them are not breaking the bank. It might be a $7 outlet cover. It might be a $30 handrail that you can install for them. Or, you know, you marry somebody who does install it for them like I do for my wife.
Good husband.
Yeah. So that is a big touch point there for me. Obviously, as a buyer's agent as well, you need those things, especially when you're newer into it. It's good to know these things because a lot of times those newer agents, some of their first clients are first-time home buyers that might be their first eligibility, might be like Terri, an FHA. One of my best friends, he bought his home FHA because he decided to do it on a whim, and he just had a higher debt to income ratio, had good credit score, good income, but he was not the best with money and had some things on his credit report that added a higher debt to income. We're gonna get into all that. All right. Start off with FHA.
So does everybody know what FHA stands for? Is it already up there?
It's not just, yeah.
Okay. FHA. Anybody want to guess? Federal Housing Administration. Okay. It's part of HUD. Housing and Urban Development. This loan program, after we do the loan, is insured by the Housing and Urban Development. And if you default on the loan, they have all kinds of programs to help people. You can get it for $100, blah, blah, blah. But they own the loan base. Even though people pay us, they kind of own the loan after closing. They're the insurer. It is a true government product.
So first, we're going to start with credit score, or guidelines. So when it comes to the guidelines for it, one of the biggest reasons why people go FHA is it has broader guidelines. Credit can go as low as 500, and terms can get better once you get up to 580. So it is one of those things where somebody might have had a couple of things in the past that they're recovering from and want to buy a house.
So let's just talk about that for a quick second. On conventional loans, the minimum credit score is 620.
I know there's not
Some on
Yeah.
Freddie it is, on Fannie it's kind of a blend, but basically it's 620.
Yeah.
Everything is now kind of like gray area, and they don't want to put an exact minimum because if you have one spouse with an 800 and the other 619, they don't want to not be able to do the deal. But basically 620 is that guideline and had been for 100 years before things got a little, well, let's wait and see. So comparatively, to be able to get a 580 customer with a 580 credit score, even an option to buy is the only option they will have. And even though they say they go to 500, you're not going to get a buyer with a 500 credit score approved. You're just not.
I want to touch on that.
Okay, so you can do that part.
I have an exact example of that. I had somebody basically call my wife, started off with that, and they really couldn't get approved for the home they wanted. They had credit issues. They were both buyers were at like a 504, 502, right on the line. The home that they owned, they had a ton of equity. It was a new build. They had purchased it early on. They got a ton of equity, and they didn't have really much money saved. But with that score and the amount of equity they have, we were able to basically have enough of a compensating factor, which means a bunch of money down, that it was able to be eligible. So, and that is kind of one of the things that she was talking about, like minimum 620 credit score. The way you overcome certain low points, or called a weak point, you have a compensating factor. So if you have enough money down, it might be enough for us to get an approval on it. And they were able to actually buy a bigger house, even though maybe they shouldn't, but they basically were able to buy a bigger house, their forever home, and clear out a bunch of their debt, and was able to improve credit. So that's one scenario where it can.
So on a buyer with 3.5% down, which is the standard FHA down payment, they do have a minimum, which is 580. So if you have a 560, you can't put 3.5% down. You can't.
Yeah.
So when you get below that, the lowest I've ever personally gotten approved was a 566, and that was 10% down. Okay. Mike's deal, they had a lot of money to put down because they were at 504, so that credit was much more damaged than the 560 I worked with. Now, just because you have a 560 and put 10% down doesn't mean you're going to get approved. You still have to meet all the other guidelines, and there's rules about open collections and disputed credit. There's a whole bunch of other stuff, but at least you're preliminarily eligible. And from that, then we go to the next steps to verify you have 560, but do you meet these other guidelines that we can get you in and get you approved?
Yep. And that's where it breaks it out. Basically, at 580 plus, you get that low down payment of 3.5%. With most any mortgage programs, there's going to be some kind of mortgage insurance. FHA can be beneficial in that regard sometimes. I have worked with one person where their first home, they knew they were going to be there for 3 to 5 years. They didn't have 20% down to kind of avoid any kind of PMI, and FHA for them had a lower mortgage insurance rate. So it made more sense for them to just go with an FHA loan.
So a lower mortgage insurance rate, how does that benefit the buyer? Do you guys know?
Less monthly payment.
Exactly. So the monthly payment can be significantly less.
Yep.
If you're working with a conventional buyer and they have a lower credit score, let's say 660 or so, but they still can get approved, their mortgage insurance factor could be like 1.1, 1.2%, where FHA is
0.55.
0.55. So if you go from paying $280 a month in mortgage insurance to $70. Okay, so it's that kind of a difference that it really makes a big difference.
And that's where it mattered for her. This buyer was her monthly payment. So that's why we're doing FHA. And actually right here, this is actually what makes up basically your credit report. These percentages is what makes up the credit report for a mortgage. So that is exactly what it's broken down to as a pie chart.
Oh, is that like how you get your credit score, like what goes into credit score?
Yep.
And we have a whole module on credit scoring and how you can improve your credit and what you do's and don'ts. That is a different module, but we can, if you're ever interested, we can get it set up through Andrew or through the training. I've done it here over 15 years. I've been here probably 10 to 15 times, but we haven't done it recently. So if new people want to get into that, let us know and we'll.
I have it on my to-do for class.
Okay, good.
So let's talk about below 580. That range is going to be that 500 to 579. At that point, a 10% down payment is required. Once again, maybe 10% isn't what gets it approved. You might have to put a little bit more down, but that is what the minimum guideline is the 10%. With that, since there's more vested in from the buyer, it does not require an upfront mortgage insurance. There is still a monthly mortgage insurance. but it's a little bit less, it's 0.5. And after how many years does that come off? 11 years that actually will come off. FHA, 3.5% down, that 0.55, it will never come off. This, it actually will come off.
So that's with anybody. You can have a 700 credit score and put 10% down. With 10% down on FHA, the mortgage insurance rules change. It's not required to be kept forever, regardless of what your credit score is. But if it's low, you still get that benefit. They don't take that away from you if you have a 570 or whatever.
Correct. All right. So this is one of the things, new agents, good to know. And you might not remember it right off the bat. So that's why you have that's why you have trusted lenders you work with. You can kind of collaborate with them. I always tell agents, hey, if you have a question about something or you're showing some properties, send them my way. I will vet them. If there's any red flags I see, I will let you know. But one of the things that you do need to look out for is septic and well location. Because if they are not within these guidelines, you cannot get it approved.
Okay, now let's stop there. So on what inspections are required first when you have a well and septic? What does FHA require versus what you may want to just choose to get for your buyer? The only inspection there is for FHA, they don't require inspections. Right? They don't require the wire. Do they require the wire?
Whenever an appraiser, during appraisal process, if the inspector calls out septic or the well, you're going to be required to have an inspection done.
So if the appraiser says, boy, that looks bad, that drain field's all bubbly, I don't know what's going on there, that you're going to have to get an inspection.
Yeah.
But without that, without the appraiser stating that, FHA doesn't require any inspections. FHA themselves. Now, if you have an FHA loan and you take it PHFA, there's extra requirements, okay? But FHA themselves, no harder than conventional.
Right.
On the inspections.
Once again, as a listing agent, good to know.
Yeah.
But it's one of those things as a buyer's agent, you definitely want to set the expectation with your buyer. Hey, this may come up. This may be an expense that comes up, would be an inspection on these things. So well to septic tank locations, 50 feet. So with a well and a septic tank, they're both in the ground. And as you can see here, I have an example of what a well is actually doing. We generally understand what a well is accomplishing. You are digging down to the water table and it is collecting water and going to your filtration system in your house. Septic tank, it's a septic tank, it's a tank in the ground. So if one were to leak, aka this septic tank were to leak, get into the water table, you're gonna be sucking up, your not good stuff. Or byproduct or exhaust. Well to property line. In most properties, there is like buffer zones. Well is no different. You need to be 10 feet off the property line. And then well to septic drain field. Do you want to explain drain field? I feel like this is something that you would know.
Do I want to explain drain field?
A drain field versus like a septic tank.
Well, it's just actually going out into the soil. A lot of the times you see it more in my experience and understanding is you see it a lot more in like bigger properties. A lot of the time, whenever like you don't see like a sand mound, it'll actually start to kind of trickle out into the ground. There's like they call it like a drip system, which is typically what you see on like a hill or something like that. Honestly, realtors go their entire lives without seeing one.
Yeah.
I grew up in a house that had one in Dover.
A drip system.
It had a drain field.
Okay, yeah, drain field.
And that part of our yard was always the greenest part of the yard. You knew where it was because it was always green. I mean, with big expansive rural properties, and that's
Right.
what you do have to, because our house was old. We didn't have the sand mound and all that. So,
I gotta imagine that there's like a lot size requirement for an SEO to say that you can have a drain field.
Yeah. I doubt people are putting them in as much today, but a
Yeah.
lot of older rural properties will have them. So how do we get this information?
What if you have to help the?
The appraiser
Oh, the appraisal?
gets it to us, which means the seller has to flag where those things are. Now, again, it's not an inspection, but this is something that a conventional appraisal wouldn't do, is say, oh, I've often had an appraiser call me and say, I don't know where the septic is, I can't do my measurement. So you, as a seller's agent or seller, will need to provide information so the appraiser can take his measurements.
Would the township usually have that information? In your experience?
Yeah, but if you're a
There
real
are
estate
some
agent, what-
SEOs that'll have it, that'll keep it just because somebody sent them some kind of a plan, but
it's much
don't know.
easier. They just, I think the seller just needs to put something in the ground.
it probably, I mean, yeah, it should show up like a survey.
It should, but I mean, the seller as the property probably knows where it is, and the appraiser will accept that. They don't need you to go to the township, but that's an extra step. As the selling agent, as the listing agent, put a stake in the ground. That's all you need. I mean, you can go to the township and do all those things, but if it were me, I'd put a stake in the ground and make sure it's 75 feet away.
Yep.
If you hear what I'm saying. Jim.
Wink, wink, yeah. It's fair. I like the way you think, Mark.
Andrew, you had a question?
I was just also gonna touch on another FHA. I was gonna let it finish, but I want to touch on another, if FHA sees signs of.
Yeah, like we were going through them all, like the different things.
Oh, you're
that-
going through the different ones.
Yeah.
that
We
an
kind of
FHA
were.
Can end up
Flag.
requiring or flagging if the appraiser sees it, or if the specific lender decides that they need like.
Which was, and what's one of yours? Because we might have already gone through yours.
I was just talking about a WDI, like.
Would
if,
destroy
Oh.
insect.
If
Oh, yeah.
an appraiser sees
Termite.
signs of like.
Termite damage.
Or something like that.
Yeah.
They request but it doesn't, yeah, but like you said,
not a-
FHA it's not a requirement, it's just hey, if we see something, maybe it's probably a good idea to get something checked.
So if you're, as a listing agent, are walking through a property and you start seeing some of these little things that might make it, oh, I don't know if this will go FHA without a lot of work, right? That's when you put cash and conventional only. But I have seen cash and conventional only on every home that's listed, even on beautiful homes that I am 100% sure would pass an FHA inspection.
I called the agent and asked him why they haven't checked.
Right, I mean, it's silly.
Might
I
as
mean,
well.
yeah.
I got a VA over 12 cash and conventionals, and they weren't even accepting VA.
right.
In headers.
It's silly, but they'll put cash and conventional only, and you're like, but it's a brand new townhome. I know there's not,
Right.
From a listing though, to the seller to choose what
Right.
they would want.
but you guys need to educate the
Educate
seller.
the seller.
If the seller, if the
Sell
house,
as agent.
You're coming
or
out
the
of
seller's
third.
agent, right, if the house is in good condition, there's no reason it shouldn't go FHA. But Andrew's right, if an appraiser's walking through and says, oh, termite damage, that's why it looks like it's gonna, and oh, wow, look, there's wet basement, and, we order our appraisal in the first week that we take the loan application. If there are things that that you can fix to do a better appraisal, point them out, let the seller fix them. Sometimes it's like you said, what, $30 handrail or
Yeah.
whatever it might be, I
Smoke
spent 100,
detectors,
what's that?
smoke detectors, every bedroom.
Not in all counties, believe it or not,
Really?
all floors in
All floors?
Dauphin and Cumberland. Yeah.
But you're right, there are a lot of areas where they.
Yeah.
And some appraisers, specific appraisers, will call for every bedroom.
Yeah.
And it
I had that, so
And-
that's
and
why
it-
I'm saying that.
and
Cause I put them up on the floors.
It drives me crazy because it should be black and white, but it's not. It's some appraisers, and rather than fight them, let's do it,
Right.
so, yeah. So I always say smoke detectors on all floors, but if you're in Adams County, 100%, they do at each bed. And apparently some of yours.
Yep,
So,
yep.
Any questions on locations of septic and well? Moving on.
Nice graphics.
Thank you.
I mean, that's happening, Mike did.
All right, so FHA pros and cons. So we did talk a little bit about these aspects already, but they're kind of outlined here, so let's go through it. So broad credit guidelines.
Way more permissible than conventional,
Yeah.
way more.
As we've talked about, I mean, generally speaking, if you have like a reasonable down payment for a conventional, you're lucky to get approved at like a 685 to 690, even 700. So that's how much different it could be. But it is not always a credit issue. Like I mentioned, my friend, he had a debt to income issue. So is that going to be an absolute killer, or is it going to cause a big cog in the wheel of closing a deal? It may not. It may just be a little bit higher on the debt to income side of things. So
What's the maximum debt to income ratio on a conventional loan? Does anybody know?
31.
50.
What?
Okay, so let's talk about, first of all, let's just talk about debt to income ratio, because we use it all the time as a term, and I don't know that everybody will understand what that
I
is.
didn't know it was that high.
So debt to income ratio means what portion of your income is going to be needed to cover the house payment plus
Gross
all your other debt,
gross.
gross income. Your gross income, what percentage is needed to cover the house payment plus all your other debt? So on a conventional loan,
On a credit report, sorry. But generally speaking, on a credit report, because some people are like, oh, I have my Netflix, I have this.
yeah,
They start naming all that stuff
yeah,
off.
just loans and credit cards is all we care about. So the other 50% goes to the Netflix and your food and your insurance, okay? So let's say you make $5,000 of that 60,000, right? If you're getting a conventional loan, it's 50%. So your maximum debt outlay is $2,500. Is everybody with me on that?
Yep.
So if you make $5,000 a month, and conventional says you can only go to 50% and can't be 50.00001. It is 50. It could be 49,999, but it can't be, it's strict. That is the most your 2,500, the most your house payment and your debt. If you have a $500 car loan, that means $2,000 is your maximum house payment. Okay, that's debt to income. FHA doesn't really have a maximum. Not really.
Really?
If you have an 800 credit score and a large down payment, you probably can get to a 60 something.
Compensating factors. But generally speaking,
It's about what?
57 is where
Is-
you're going to be
yeah.
able to get that.
Yeah, you'd have to be like the best candidate ever to go into the 60s, but it happens. Okay. So that's debt to income ratio. FHA is way more liberal with credit and now debt to income ratio. So you can buy more house with worse credit with FHA. That's where we are so far. Okay.
Next, for one comparing to conventional, if you do even like a 5% down conventional, you're limited by getting 3% seller help. You can still do 3.5% down FHA and get 6% in seller help.
And I know that sounds like you might not get that, but I'm back in 2015, 16, 17, 18, sellers were getting offers with them paying 6% seller help. And because it was not a seller's market, it was an even market. We often saw FHA $200,000 sales price, seller paying $12,000 in costs. It happened a lot. You didn't need all the programs that gave the assistance because the seller was paying the cost back then. It will happen again, and you're allowed to go to 6%.
One thing about all government loans, I just have it in this one in particular, they are assumable. So say somebody is 5 years in, got a peak insane interest rate. If you want to purchase that property, as long as you qualify for FHA guidelines, you can assume that loan, meaning you'll assume their interest rate. You'll keep that same interest rate, which can be a huge selling factor if you're selling a property. My dad actually just purchased a property from somebody in Steelton, and they assumed their loan. Yeah, got a good deal on
So
it.
if you bought a house when the interest rates were 2.75 on a 30-year fixed rate, and you're ready to sell your home, and it was an FHA, VA, or a USDA loan, is it not a selling factor that your buyer can come in and get 2.75? Now,
Especially in low inventory, like what we have right
the hard part on this is you have to have the cash difference between what the loan balance currently is and what they're selling for. So you do have to have this down payment, but to get a 2.75 interest rate, you might be able to scrounge up the money to do that.
Which I don't know if it's on here or there, but you can also receive gifts. So mom, dad, uncle, grandparent, sister, brother, they can also gift you funds for this kind of stuff. So once again, it can help fill that gap. One thing that is seemingly getting more and more popular is the phrase or term house hacking. We generally know what that means. So you buy a 2 to 4 unit property. One of them is going to be your primary residence. The others you can rent out and all that kind of stuff. can purchase that 3.5% down. Pretty good.
Four
investment.
unit property with 3.5% down payment. Amazing. We see it all the time. And you're able to count some rental income, even though you've never been a landlord. Most of if you're buying homes, sometimes you have to have landlord history, and so there's guidelines about but when you're buying one of these, you can count some of the rental income on the other units to help you qualify to purchase them.
Before you purchase the property, you can assume what your income will be on the,
We either get leases, or you actually need leases on FHA, I think, to show that who's going to, you actually need a 1-year lease on those units.
okay,
So, yeah, I was gonna say on conventional, sometimes we count the market rent on the appraisal, but to count the rent, you actually have to have 1-year leases.
okay, so if there's tenants already in there.
If
you
there's
can just
tenants in
get
there with the
leases.
lease, that's even month to month, if there's tenants in there, we'll count, we can use that. Now, let's say there's 4 tenants in there, and you're buying it as an FHA 4-unit property primary residence. What has to happen?
Dude, if somebody,
And it has to be in writing, and we have to have it in our loan file that you have notified them that they are vacant. Because otherwise, it's not an owner occupied property.
That's the key.
can any of those units be like commercial space?
Yes. On FHA, the rule is your residential side must be 51% of the space.
Majority residential.
Okay, so it's not the amount of units, it's the amount of square footage. So let's say the first floor is a big open storefront that they're gonna put a beauty salon in or something like that. And upstairs you have 3 small apartments. You're gonna live in one of the 3 small apartments. If that square footage of that bottom is more than 50%, you cannot get financing. You can't get traditional, you'd have to go commercial.
See it a lot more in like the city or like downtown, like
Yeah.
small towns and stuff where it's like, maybe it's right around like the town square or something like that, where it's all commercial and then there's places, apartments above it, yeah.
Yeah.
Terry, are you ever asking for like a Schedule E or anything like that? Like, do appraisers ever ask for a Schedule E?
Appraisers don't, but our underwriters do. The Schedule
Or,
E is
yeah, sorry, not the appraisers, the underwriters.
Yeah, so Schedule E is the real estate owned screen as scheduled from their tax return. But if you're a first time buyer buying a 4-unit, they wouldn't have that because they're first time home buyer.
Well, I meant like, would they ever ask, like, so for me, if I'm trying to write on like a multi-unit or something like
Right.
that, but still even under 4,
Improve your landlord experience.
well, no, to like, a lot of the time I would ask for Schedule E's.
We'll ask for
Just to try and make sure that like, hey, this is actually lining up with what you're giving me in associated docs.
No, we're not gonna ask the seller to show that they're actually getting that money. That's what you're saying?
Yeah.
The seller, no, we're gonna ask for leases,
It's just leases are fine.
just the
Okay.
leases. Now, if a buyer owns rental property, we're gonna get their Schedule E's on their full tax returns. Like, you have a buyer who owns any real estate, we're getting their Schedule E's, just FYI. So, if you're just like a salaried person or an hourly person, we don't ask for your tax returns. But if you're self-employed, get a 1099, have rental property, we're always gonna get your tax returns.
So how do you know that those tenants then are actually paying that? Are actually paying that?
We don't.
rent? So it's just kind of, you're going by trust and belief. Okay, fair enough.
Well, the appraiser also has to give us market rent for the other units,
Which is fine.
so it should be close, right?
You would hope so, as long as somebody's paying the rent.
Right.
Yeah.
Yeah, so. Now, as a buyer, you may want to request those things to see
I
that,
would, yeah.
but the lender doesn't.
Maybe not every time.
Would have, like, in order to
You're
count
getting-
rental income, we usually ask to see like a copy of the first month's payment, and, the ones that have to prove it, you have to prove it, but
Right.
this doesn't.
You can't request, stuff like that.
So like the P and L, but also just making sure that like.
Like a cash flow
the current
analysis.
owner, well, yeah, for your cash flow, and,
As a buyer, you say, I have these 3 tenants and they're under lease.
But to make sure that they're actually.
What if it's a brother, sister, and mother and they pay? Yeah, they don't
Like
pay.
math,
Right.
that's how you like, hey, and this kind of,
Yeah,
for anything, any kind of applied property, just add the buyer. Or
is
prior
that
to
just
it.
like the tax, like paperwork?
So it's like supplement, so it's a part of the It's part of your taxes. It
It's
shows
part of
like
your
supplemental
1040.
income.
Okay,
It's rent, royalties, and something schedule, and if you receive rent, it says address of the property, property A, B, C, how much rent you get, how much you pay in taxes, what you pay insurance, blah, blah, and you all get it down to a bottom line. So that would show that they are claiming rental income that they receive from that property. So nobody's gonna claim rental income they don't actually receive.
Right, yeah.
Right, yeah, because they're paying taxes on it. Okay, I guess. got it.
The 6% seller help as a buyer's agent. Is that something like you're educating the person financing on, like what they can request up to when writing an offer? Or like, are we expected to know that?
Your lender should say something, but I like Terry and Mike would absolutely say something. I would just recommend.
We sent an email and said, okay, this is what you qualify for. I've used the FHA program showing 6% seller help. You may not need all 6%, blah, 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 you know.
Gotcha.
But if I'm doing a different type of loan, like a PHFA loan, Mike's gonna send something that says, okay, I'm 5% assistance for PHFA and they're still short by $2,000. You're allowed to ask for this. Not sure if the seller's, what I always write, I don't want people to assume that they're just gonna get seller assist, right? And they don't know any different. So I always write, you're also allowed to get 6% seller help. However, in this market, many sellers are not offering to pay closing costs, but talk to your agent about that. And I put it in every one because I remember being young and I heard you could get 6% seller help. I just thought it was like a thing that everybody got, right? So I need to tell them they can get it, but it's not common in this market.
Right?
It's a great
Yeah.
question.
Okay.
In regards to that, like if my pre-approval is based on them receiving seller help, I'm gonna specifically outline that in that email.
Okay.
And like whenever I talk about any application that comes in, I'm gonna call you and give you a whole rundown of the
Yeah.
whole situation.
Okay.
And I also let them know like, hey, since there's this gap here of $5,000, you're going to need either, it has to come up from somewhere and you can't get it through seller help.
Yeah.
It's also, excuse me, it's also good for you to know it. You said, should I know it or should you? You really should have the seller help memorized. There's conventional with, you're probably only gonna need it with people who don't have a lot of money, right? So the only two you really need to memorize would be FHA 6 and conventional 3.
Okay.
But truly on conventional, you can also get 6% if you're putting at least 10% in there. There's rules, but you're mostly going to use this with people who don't have a lot of money. So if you just memorize those two, that'll be a big help. And VA, it's everything.
Yeah.
Okay.
We'll get it.
Okay. So 3, 6, and everything.
Gotcha.
Okay.
You know, well, all about VA getting all the seller help.
Well, and yeah.
Speaking of not having a lot of money, one of the things that can kick somebody from out of conventional and into an FHA program is having reserves. Traditionally speaking, conventional requires you to have 2 months in reserve. So once your closing costs are paid, you need to have 2 months of mortgage payments still left in your bank account. With FHA, you can get approved with having next to nothing. You could basically put all of your eggs in that basket and have nothing left over. So be a benefit. Obviously, it's a precarious situation, but it is still going to be proved on. Another great thing, which I love this, and it's going to be more of a thing, I think, is the 203K renovation loan.
And everybody, please come get some pizza so we can talk through lunch too.
Yeah, let's do that now. And then we'll
Yeah.
keep going.
And we'll just talk through if you don't mind.
And then great.
What other one?
Yep.
Yeah, we're
I'm like one more too.
so you want to add?
Barbecue chicken pizza,
Looks so good.
white cheese, pepperoni. Bring it to the refrigerator back there.
And this kind of stuff is important too, because you guys are, like, you guys actually offer it. Most, so I shouldn't say most, but
A lot of
lenders don't offer it. You guys offer everything.
everything. We have
Yeah.
every product.
Including chattel.
And do the chattel.
In fact, I got a call from some title back.
Oh, yeah. Andrew.
Did he call
You
you?
did call me.
And
We were doing
Yeah,
this.
we were about to come
Okay.
out.
no kidding.
Yeah,
I'm gonna
so
reach out to him then.
I was going to call with him.
He's got excellent
know.
credit,
Okay.
he said.
Mhm.
So they're looking at the mobile home that I have Two Rose Ave,
What's your
Okay.
list price on that one?
129.
What's the nice?
Yeah,
Where you live?
Yeah, one of my guys, so it's drywall, the appraisal will be.
It looks
new
like
this
a
year.
ranch, yeah.
It looks like a ranch house,
Yeah.
it's on a foundation, it feels like a house when you
Yeah,
go
it just
into
has
it.
lot rent.
Yeah,
so.
take two
Yeah.
pieces so you don't have to come
Yeah,
back.
so lot rent on that, 770.
Come on, Andrew, take
That
two
includes
pieces
all
so
your-
you don't have to come back.
I can't believe he called you.
Really?
Yes. This guy was there for an hour at the open house. And, him and his family, and then there's a little park across the street. They left and went to the park, sat there at the picnic bench for about 30 minutes, and then they left.
Mhm.
So I was hoping, I
They were
reached out
close.
yesterday, but I didn't hear anything.
Is there anything weird about your timeline or the mobile or anything that would make it strange? Or is
No.
it straightforward?
Straightforward, yep. Yep. Roof is less than 10 years old, like the entire thing is new. The entire thing, so. Yeah, it's a beautiful place. I
Yeah,
would live in
it looks
a
like,
heartbeat.
when I first saw it and everything, I was like, I don't know why this couldn't be approved conventional, but then the lot rent thing is,
It's the least part,
yeah.
What's your lot rent there?
770.
I had one yesterday, $750 lot rent.
Yeah, they're all going up like super crazy unless you're going to like Shippensburg, they're like 580 down in that way. I have a client right now that has a pre-approval
Mhm.
for $30,000 for a chattel,
30.
30.
By an Odyssey.
I said, why don't you buy an RV and just drive? You can park it, live in it there. She's 76 years old. She's like, come and leave. But oh my gosh, Andrew, you gave me best news.
Good.
That is amazing.
Don't read my piece, so I don't remember.
That would
Okay.
be- That would be great. And real quick, chattel is the hardest one to get, is that right?
It's harder than conventional. You mean the qualifications?
Yeah.
Yeah,
So
because they
it's
don't,
easier for an FHA, I see
Sure.
a lot.
because like
the
if you're getting a
capital.
mobile home, the mobile home lender doesn't allow you to have any unpaid collections or anything like that. So you could have like $150 collection with, I don't know, your electric company from 3 apartments ago, and you can't get a mobile home loan. Don't care about that at all for traditional financing. So those kind of things, yeah.
And then you gotta get parking, so.
Yeah, so if you've had like any type of like arrest or anything in your past, I've had people go through the whole process and then not be able to get park approved
Yeah,
Yeah.
so I nipped that in the butt in the beginning.
right up front.
And this park that I work with, I got the manager fired.
Oh.
She was really terrible.
Mhm.
Actually, one of my clients, Cindy,
Okay.
is now the manager of the park.
Oh, wow. Okay.
I got him in.
There you
Good,
go.
good.
And
Hey,
she
but-
had a terrible time with the old manager, so she knows
Yes.
exactly what to not do.
Exactly, yeah.
It's amazing.
So one of the things that I wanted to add that Mike had talked about when he talked about debt to income ratio on FHA, if you have student loans that are not in repayment, and I'm gonna say 50% of our clients have student loans that are not in repayment yet. So on their credit report, and maybe just because the different laws and all about student loans over the last few years, they were gonna be forgiven and then not, whatever, there's all kinds of like deferred student loans. We still have to count a payment on all those student loans, even if it shows someone's not going to pay it until 2029. I have one right now that says deferred until 2029. We still have to count payments. FHA allows you to count 0.5% of the balance. On some conventional loans, it's 1% of the balance. So FHA for debt to income ratio also gives us a more lenient qualification cap than some of the conventional. Oh, you were gonna talk about 203K.
Yes, renovation loans.
Has everybody heard of the renovation loans?
All right, Al.
I know you've been around. Have you guys heard of renovation loans? Do you know what they are? And if you don't, it's okay if you don't. That's what we're here for.
Can you guys give just a quick run on that?
Oh,
'Cause
yeah.
I think that's super important,
Yep.
especially for newer agents. We're not in the $500,000
You and
range.
I were having that one.
I did.
Yeah.
Yep. You know, we're starting out in lower brackets where there's more opportunity for things like that, a loan type like that.
So if you get approved for, let's call it $350,000 and you want to buy a place that needs some things addressed for $280,000, your basically renovation ability is whatever the purchase price is between that and what you're approved for. So in that scenario, it'd be about $70,000. And on top of that, is this if FHA 203 is also if it appraises for even more, technically you could go up to the appraised price.
That's all.
Okay, so and if it even appraises for more, you can go up to the appraised price, and they will use a calculation to after renovations the appraised price.
So on a renovation, from your perspective, you go out and you write a contract for your buyer with the seller, right? You find a house, it's 180,000, or what do you say, 270, what was your, 270, let's say it. House is selling for 270. I'm gonna make it easy. I'm gonna say 250 because I can do math in my head and a little bit better like that. So the house is selling for $250,000 and your buyer walks through it and like, oh, I can't live here now. Like, oh, look at these kitchen cabinets, but everything else is good. It's sturdy. And you're trying to convince them that this is has good bones, but they can't get past like the current look. They're thinking HGTV, not what's available in Harrisburg. This loan can take the 270, oh, what about the kitchen counters and turn it into the HGTV home. Because you write an offer for the $270,000. At settlement, the seller's paid his 270 and he's gone. Okay. But your buyer also writes a contract with a GC, a general contractor. So if he wants 280 for the house and $100,000 in repairs, we add the two together and we pretend like the sales price is 380. Okay, 280 plus the 100,000, 380. The appraisal has to come in for the 380, not the whatever you sold it for. I know my numbers have jumped around a little.
Yeah. I'm gonna say, wait, what?
She's renovating as we go. Just put value in it.
Buy the house for $250, put $100,000 of renovation to it. The after value is $350. 250 plus 100 is $350. Okay, it has to appraise for $350, but they only need 3.5% down off of $350,000.
3.5%.
It's FHA, so it's
Yeah,
3.5% down.
everything else that we just talked about applies.
Okay.
On the after improved value, the two added together. The price and the price, the contract price and the home price, renovation price and the home price go together and 3.5% down off of that.
So is the appraisal done after the renovations?
No,
Okay.
They will be able to assess it for, because you gotta think about it. If you saw bones of a house, it was a 3,800 square foot home with nice solid beams, wood floors that could be restored. I think you'd be able to generally running comps, you'd be able to say, okay, this is comparatively speaking, this thing was up to code.
If it was up to. Okay.
Yeah,
After, we call it after repair value.
yep, after, we call that another term, acquisition value. To acquire it, it takes both those things.
So
Something
what does
like that.
closing costs look like on that? Are you paying closing costs on the full loan amount? So the
Well, you're
350,
paying transfer tax on the sales price only.
so the 250, you're only gonna
And
pay
transfer tax
1%.
is one of your biggest costs, the
Right.
closing costs. You're gonna pay that on the sales price of the home.
Okay,
Closing costs on a renovation loan are a little bit higher, okay, because you have some permits and things like that.
right.
But a lot of stuff can be financed too.
Okay.
I would say on that scenario that we did with the 250 sales price with 100 in renovations, you're probably looking at needing $25,000 to $30,000.
Okay.
If you buy that house outright without a renovation loan, you're probably at 22 to 25,000.
So $5,000 difference.
Probably about that. Is that what you would think too?
yeah, that's what I saw.
Okay, so
So how it works, but to get back to Nicole's point is contract with the seller. Now you got to meet with a contractor to go out and walk the home and tell you what's needed. You need a contract with the contractor. It has to have, if you're adding rooms or knocking down walls, we want plans, specifications, description of materials, the whole kit caboodle. That all goes to the appraiser. We can't get the appraisal until we have all that. That all goes to the appraiser. The appraiser says, yep, with all these renos, your house is worth $350. Now your loan's approved, hopefully, and you go to closing. At closing, the seller is paid off, 100%, seller's gone. That $100,000, depending on how you do your loan, if you do it as a streamline, the contractor can get 50% at closing. Okay, if you do it as not a streamline, they can't get anything at closing. Streamline is up to $75,000 in repairs now. Okay, so if you keep the repair costs at 75 or under, the contractor can actually get half the money at closing. Okay, then, but let's assume like you're at my example, 100,000, you're not a streamline. So we put that money into an escrow account. And as work is done, the contractor and buyer calls us and says, hey, not us, but we need $25,000. Appraiser goes out, inspects it, makes sure the work is done, then $25,000 is set out. Now they come back and say, well, now I've had done all this, now I need another $50,000. So we send the contractor, the appraiser out. He says, yep, it all looks good. Then the money goes out. Eventually, all of that money will be sent out to the contractor. They have 6 months to complete. Most of these projects are cosmetic and should not take 6 months, but if you're building additions and so forth, you might. And if you're doing that type of a loan where you're like knocking down walls and you can't live in the property, you can actually finance mortgage payments for 6 months. So.
And there's no possibility of that 100,000 going up now because, the contractor gave.
There is, on all projects, as you know, costs coming higher. So there is a minimum 10% contingency reserve built into all deals. And if it's higher cost or there's some reason that we think there's an issue, we can even make it up to 20%.
Okay.
Have you guys ever had to, in the middle of a transaction, because something came back like C5 or C6, like have you guys ever had to like switch over to a 203K from
Yes.
or in the middle of the, I was
Yes.
gonna say, how was that? Walk me through that process. What was the timeline like?
Well, when you get, so there is something, each appraisal, what Terry's talking about has a rating. Conventional
Condition, yeah.
for condition.
For anybody who knows, so the condition rating is C1, C2, C3, C4, C5, C6. C5 and C6 will
We'll actually do C5. We have a minimum C5. We
really.
won't do all
Most
C5.
lenders won't do C5.
We have a minimum C5. We're gonna look at it, but
Okay.
we will at least consider it at a C5.
Okay.
Okay, we
C5 is really, really bad, like you shouldn't be.
lots of deferred maintenance on that. It probably comes back that we'll accept it, but maybe need a final inspection to like fix the hole.
Where is the C?
I have a list.
Is it on appraisal?
It'll
It's on the appraisal.
Okay.
And if you want, I have what's saved on my desktop when he sends it out. I have what C1 means, what C2 means, what C3 means, what C4. And each appraisal has that on it. You just don't know because that's something you haven't looked at. But
Yeah.
we look at that.
I got smacked with the C5 once, which is why I'm like, what was that process like?
The first thing we would do is just try and say, hey, if we get a final inspection to upgrade the Zitsco electric box and do whatever, will it still be acceptable? It probably would. But if not, if it's so bad that it needs reno, then they gotta get the contractor. You gotta get a contractor involved.
Right.
You're gonna have to do an addendum with your seller to make sure they're okay with another 30 days. Okay. You gotta get the contractor involved, get all that stuff put together, get it back to us with plans and specifications and descriptions of materials and a whole entirely new appraisal from FHA, because we were conventional, comes back in. So probably 30 days.
So just an extra 30 days. So if you guys were to have somebody, if somebody was to come to you guys from a completely different lender, lender's like, hey, I'm not gonna finance on a C5 or C6. And they say to you guys, they
That's
come over to you
45 to
guys.
60 days.
So 45 to 60 to go from start to finish if we're gonna.
Right. The reason I say 30 is because we've already approved them and had everything else
Right.
except for the appraisal.
Perfect.
But if you take 3 weeks to decide on which contractor you want to use and get that stuff to us, it's not going to be 30 days. I mean, assuming you get your, whatever the contractor is going to do and get that right up to us so we can get it to the appraisal, so if you take longer, we need to take longer, so, and I don't mean you, but if the process takes longer and it's 3 weeks before you get us that stuff, we cannot get everything done in the next 5 days. Just can't.
And to my people too, I would recommend you find a contract that will not only go out and give you an estimate for free, but if you can find a contractor that will also defer payment until after closing, like that's gold.
And they can get 50% at closing now.
Okay.
So they can get some money.
Well, yeah, at closing.
Right. But they haven't done anything before then except for walk the property.
Yeah, it can't start
They
renovation.
can't,
Well, yeah,
rental
no,
can't
you
start.
You can't reno. Well, sorry. So I was more so saying like, hey, to like meet an appraisal or something like that for like some of this, not a.
There's gonna be a lot of back and forth.
We're
Yeah.
talking about contractors. I'm like, quick.
They don't want to do anything they don't have to as far as paperwork and stuff. Right. Okay, go ahead.
But one of the things that somebody had mentioned earlier was a lot of lenders do not provide 203K. It is because they are so much different, and this is where CrossCountry really sets ourselves apart from everybody. We have a dedicated renovation team. That is their sole mission every day they go to work is working on renovation loans. I have worked through 2, one closed, the other one they just decided to hold off on. both praise the process. And that is going to be the biggest difference when it comes to going through something as complicated as a renovation loan, is having people who are familiar with the process and setting that expectation. Terry and I, as your loan officer, will be there to provide the customer service, making sure things are going smoothly. If a question isn't getting answered because they are potentially working on a nationwide, aspect, we're there to answer questions along the way, make sure everything is kosher with them. And that's a real big difference. And this is not government related, loan related, but our in-house renovation stuff. We can provide AI imaging after renovations. So one of the things that they mentioned on one of the calls that we had was they were working with an agent a long time. That agent was listing a home that needed a rehab loan, essentially. They basically work with their cross-country DCM lender and 2 hours of sleep. Let's just clean the cabinet back. They work with their CCM lender and actually gave a bunch of images of it all redone. So when they did their open house and they had people showing the home, they could see what it would look like after renovation was done. Really cool little thing there.
So 2 points real quickly that I just wanted to say, even though I have cheese on my feet. Is first, we also do conventional renovations. So we do renovations in all loan types.
Yeah.
So just FYI. Same things, same reasons you would do it, but we do it for conventional, we do it for FHA, we do it for VA, some of that VA is tougher, but we do it. So that's the first point. And the second point, oh no, you were just saying about AI? This is again, not related to this, but one of the agents out of this office, Ruth Kalp, I don't know if you know her. She, I work with her on many of her deals and most of her deals. And we had a buyer who was in like the $220,000 price point, but had champagne tastes, right? But at $220,000, you get what you get. So she found this nice little brick rancher in Harrisburg, and Ruth went out and showed, she was not sold on this house. And Ruth went out, I showed you what it was. I have the pictures. I was astounded, and put in bushes and changed the awnings and did like maybe $2,000 worth of work that she showed her the costs, and it completely sold that house. It was amazing. I showed you when you first started.
Yeah.
It was amazing what she took that house and what it looked like, especially in winter, brown grass, right? And then put a couple shrubs and maybe a little portico. And I was like, I'll buy that house.
Yeah.
It makes all the difference. Use AI to your advantage if you can, even though that is nothing. So.
All right. The last portion here, cons. I think we've kind of addressed some of the drawbacks that are going to happen. You're going to have a more rigorous appraisal. Things that are going to be called out that they would traditionally wouldn't be called out. And that
Health and safety issues for the most part.
Yeah. And that opens negotiation. So on the listing side, that opens you up a little bit. As a buyer, that might open up a door for negotiations to get that said 6% seller help, reduction in purchase price, things that you could potentially use to your advantage, or you just get them, fixed. Because you're obviously going to have that happen anyways.
Any other cons that anybody knows or can remember? We've talked about just a couple. So a stricter appraiser is one.
Just with all that, typically considered less desirable than conventional. I know it kind of goes without saying, but
Exactly.
just to say it.
But here's one for sure.
Could also be a 30.
Yep, could be a little bit longer close. It really shouldn't be a longer close. If it's a normal loan, it would be the same. If you're doing a conventional versus FHA, there's no extra time for that. If you're doing a 203K, there is extra time for that. But what is a downside is if you have 3.5% down, you pay mortgage insurance for the life of the loan. We talked about that. So if you have an 809 credit score, but just can't make that down payment, you could have gotten a conventional 3% down loan potentially, where when you get to 20% equity, you can request that cancel. How you get out of it on FHA is you refinance. So there's always a solution, but there is some, no product is perfect.
Right.
Call Mike and Terry to refinance.
Yes. Okay, we good on that one?
Good.
Are we switching to a different product?
Great question. Yes,
Okay.
we are.
So before we switch, any questions on any part of FHA? What does FHA stand for?
Federal Housing Administration.
Perfect. Yep. Great product. If you have questions, call Mike, call me. We can dig deeper, but there are some fluky things with FHA. If you have more than $1,000 in disputed accounts on your credit report, we have to downgrade to a man. I mean, there are rules that we have to follow. Okay?
Income is calculated a little bit differently.
Yes, income is calculated differently, but it's still a wonderful product and should be considered. And I think we will start seeing more of it. So don't be surprised as we see that.
Yep.
Okay.
All right, my personal favorite, VA.
Before you go any further, what does VA stand for?
Veterans assistance.
Oh, what is
Veterans
it?
Affairs.
Veterans Affairs. Also a government, actual government agency who insures or guarantees these loans.
On the buying side, there are so many pros. I don't even know if I have everything in here. That's why we have the
Oracle.
Yeah, exactly. I was gonna see some kind of word for that. So let's get into that. First and foremost, there is no minimum credit score. These loans are factored on compensating factors and something called residual income. It's a little smaller than I thought it would be, but a calculation that we must do on every VA pre-approval is calculating their residual income. If their residual income meets another calculation that we have to do, and if it exceeds it, they are guaranteed approved. Is that fair to say? So that is Bill Terri for that. Bill Branch. That's a throw you in.
That was like instant.
But that is
Is that when you wrote residual?
Yeah, I keep looking at
moving on. Why can't AI figure that out?
Change that before you send it out.
Well, now a real person. But that is like one of the biggest issues or the biggest benefit. Speaking for my personal self, when I purchased my most recent home, one of the buyers in this situation had a card that was not set up in auto pay, and that person may have forgot to make a payment on it like months right up before this and took a 20 or 30 point hit on their credit score, which changed the dynamics of this. So we used a compensating factor to get past that.
So let's talk real quickly about this. I'm sitting back here so I can see the graphics. I haven't seen the graphics yet. I like that, Mike. Salute the service. So what he means by residual income is VA doesn't just say what is your debt to income ratio. We calculate that for VA, but that's not really the main thing. This residual income is. And what VA does, they have a chart for the Northwest, the Midwest, the South, depending on where you live in the US. And it says, after you pay your housing expense and all your bills, and they actually add in maintenance and utilities for this.
Yep. Children under 12.
Take childcare. So once you figure out what the housing expense is and all their loans, plus the maintenance and utilities and childcare, they have to have a certain amount of money left over after they pay all that. So we go to the chart, like for one person, it's like $700 or $400. Like they have to have that much left over. So for a family of 4, they might want to see like after you pay all your bills, you still have $1,700 left over. You have to use the chart. So if you have that amount of money, if you have more than 20% more than the required residual debt to income, doesn't matter. And that's what Mike was talking about. So they just want to make sure, can you pay your bills and have a little bit left over to feed your family and get Netflix? Yeah.
Gotta have Netflix.
Once again, one of the best things about the king crown jewel of what everyone thinks about with VA is 100% financing, 0 down payment. To get a pre-approval, there is a little bit more of a process, but it is not too crazy. But we must receive something called a COE, a certificate of eligibility. Your buyer may obtain that, and we can also obtain that. A buyer can obtain it very quickly. As a veteran myself, you have a VA login, you go through it, you click, it takes probably like 3 minutes to obtain that. Nicole had a buyer that I worked with that was VA. She was able to pull that sucker in 2 seconds and was able to update it for us. But that is very, very critical. to getting a pre-approval. If we don't have that, I'm not gonna get you approved.
Want to know why it's so critical? It's important to know,
That's fair.
because it tells us whether or not they're eligible to get a VA loan. It is the thing that says, yes, you qualify, or no, you don't. Because to qualify for VA benefits on home loans, you have to have 4 years of continuous active duty service or have served in a time of war in a war zone. And as a reservist, you need 6 years. Okay, so sometimes I'll have people come in and say, yeah, I'm a veteran, I qualify, and we try and get the COE for like 2 months. And we can't because they're reservists. Reservists don't use the portal. And we find out they only have like 5.5 years. They don't have VA benefits. The certificate tells us you can get a VA loan. It also tells us if that service member receives any VA disability payments, which is really important because if they do, we waive the funding fee. We get that information from this form. It's critically important. It also tells us if they have another home that their eligibility is tied to. That comes up a lot because maybe they sold a home in North Carolina and moved here and that lender never released the liability. We have to go do that before they can close on the new home.
And I have a thing on that as well. 100% of all the closing costs can be covered by the seller. There are instances where people feel whenever they're selling a home to a veteran, that it is their like duty to take care of another veteran out there, and they will do it where they would traditionally do it. So there are some times where that can happen, but it's another tool in the tool belt that you can use for negotiations. This next one here is very interesting, and Oracle taught me this one because a lot of people think that it is referencing seller help, and it is actually not. The buyer can receive 4% of other assistance. You were in a class whenever we talked about this once. What were some of those things?
Things and upgrades.
There you
Well,
go.
the first thing you got to take out of there is your prepaids. Okay, so when you go on a CD, closing disclosure, there's 2 different kinds of costs the buyer pays. Everybody in the world, including us, calls it all closing costs. But technically, it's made up of 2 different things. Well, 3 different: down payment, closing cost, and what's called prepaids or escrows. Okay, the prepaids and escrows are different because that's your taxes and insurance, right? So you get 100% of all the closing costs, and this 4% of other items, the first thing that it goes to is taxes and insurance. Okay, so let's say your taxes are $3,000 a year and your homeowner's insurance is $1,000 a year. That's $4,000. So let's say the sales price is $400,000. 4% would be what, $16,000. So 4,000 of that 16 has to pay the taxes and insurance first. Now we have $12,000 left over to play with. If you have a generous seller that really needs to move a home, and again, that might not be right now, but it might be in a year. Okay, and you can get on a $400,000 sales price rather than having somebody come in and offer $375 because it's not moving. Because I'll give you $400, but I want you to pay 100% of my closing costs plus this 4%. Okay. Yes.
It's gonna be a super stupid question. Where are you normally seeing people write that on the agreement?
Just in the closing cost line.
Oh, so they are still putting it in the closing cost line. Okay, because I've never actually written it.
Yeah, you would do, see, people think there's some loan origination systems with lenders, because I've been with a few, limit you at 4% of the sales price for everything. And that is wrong. I see it come from Rocket all the time, limited at 4%. They're wrong. It's 100% of closing and 4% of other items. Okay. You'd have to write your contract like that. You'd have to say seller to pay all closing costs plus 4% of sales price towards additional items to include them. We can come back and make an addendum even if we needed to make it more specific.
Okay.
But
So
you
it'd
need
just
to
be a
get the
general-
dollar amount up front. And if your dollar amount is all the closing costs from my sheet says 18,000 and then this other 4%, you can write it like that.
Okay, yeah, I just, because I know you were saying it's not technically like a closing cost, so I was like.
It's
okay,
prepaid,
that
yeah.
helps. Yeah, I mean, that helps.
Does anybody ever call it prepaids? They say, hey, to your buyer, hey, you're gonna owe $7,000 in prepaids and $5,000 in closing. No,
No.
you say $12,000 in closing costs. Even we do, we lump it together. Technically, they are different things and have to be paid differently.
So that may be a good thing to keep in mind whenever contract.
And then again, best thing of all, you can house hack with it as well. Obviously, once again, must be a primary residence. That is the biggest thing when it comes to VA. This is for primary residence only. The veteran must be the primary borrower. But you can buy a 4-unit, live in one, rent out the other.
Can't count any of the rental income unless you have landlord experience on VA.
For how long? Yeah. How long does it have to be your primary residence?
Just all houses, it has that 1 year
You'd have to
minimum
refinance out of it,
So
basically.
1 year, and then you're good to.
Out of
to
1 year.
move on.
Okay.
Another lender, I've heard 1 year, but I also had one lender tell me years. It's like it seems like an awfully long time.
I don't, who was Evie, Rachel Evie used to work here. A while ago,
I know
okay.
you're talking about, yeah.
Yeah, she left and became like a hostess for one of the hostess that sells. The in-house rep for a builder, the host, they,
Oh,
you know,
yeah.
yeah, one of those things. Okay, and then she left it did something else. She and her boyfriend bought a house in Carlisle. And they had horrible neighbors, really loud all the time, just like really, really bad. So she wanted to move again, like within a year. And I said, you can't because you bought this as a primary residence. It will look like you're trying to buy rental properties and, you know, they're not going to go for it. So she said, how long? And I told her a year. So we got to the point that we were like we were before closing and we weren't right at the year. We were like 3 weeks short of the year because the underwriter counted out and they do this. They count it out like the exact days, not like, oh, if it's November 11th, then November 11th. I think she went and counted like however many days. And I was like, really? So they had to do a letter of explanation why they were moving in less than a year. And they had a fantastic one on topic. No, I mean, it was really, really good. And the underwriter's like, makes perfect sense. So that time frame is the year that you were supposed to live in that home. You're really supposed to live in it forever. It's your primary residence, but you don't have to. After a year, you could buy another primary residence. So,
And funding fee. So that is basically the cost. Is it goes to the VA? That's what's
it's called a guarantee fee. It's their fee. It's basically serves the same purpose as mortgage insurance.
different name.
On conventional, you have mortgage insurance, PMI, FHA. What do we have? Does anyone? It's MIP. We didn't talk about it a whole lot, but it's MIP, mortgage insurance premium. VA, it's a guarantee fee or a funding fee. USDA, it's a guarantee fee. It's all insurance in case you default on the loan.
And you can get out of that, like I was able to. Most veterans do obtain some kind of VA disability. Another really good point to like, if I'm an agent talking to somebody who's a veteran, hey, do you receive any kind of VA disability? We can save you a lot of money. If they say no, because I do have friends that I even served with that don't receive any, and they just never took the time and that'll be too complicated. There you can either contact a DAV or the other one is a VSO. Set them up with those people. You'll be a resource. That's what you want to be as a realtor. You want to be a resource for them. Those people their dedicated job is to help either get them enrolled in VA disability, just in generally help them obtain their benefits because it is a complicated process.
So I don't know a lot about this. That was new. That's something that I learned about the VSO. It's about helping them get there. But when you, as a veteran, get disability, you might only get a very small amount. Maybe you're only like deemed 10, 15% disabled. My sister was in the Army for 23 years. She had plantar fasciitis from wearing the boots. She gets VA disability payments she's been getting them for a long time, okay? So the beautiful thing about that, tax-free income. So it's all tax-free income and you get to waive the funding fees.
Yep. You just need to be considered 10% disabled and you'll be able to waive that.
What was it? BSA?
VSO,
BSA.
DAV.
Those are the resources that the veteran would contact.
Yep.
Okay.
Yep. There's gonna be a rep to each one. You set up an appointment, they'll have an interview process and
How long does it take before they give you a finding?
I don't know,
Good question.
I tried to get mine increased recently and I kind of just didn't have time to follow up with it.
Okay.
Doctor's appointment just stopped going.
I think it could be a long time,
It
so.
does take some time, but once again, have those conversations. Not every buyer is gonna be ready tomorrow. Some are gonna be ready in 6 months, some are gonna be ready in a year. You have a pipeline because it's a continuation of your business.
People think disability is like, oh, I lost a limb with an IED. No,
Yeah.
it can be hearing loss. It can be like my sister, her plantar fasciitis. I mean,
I tore my ACL, 10% goes to the ACL reconstruction, 10% is for the scar. I get also a percentage for irritable bowel syndrome.
from the
So-
stress.
So it's,
There's a mental on there too.
yes,
Yeah.
there's versions of that. There, yeah, in many different ways.
There's
Sleeping law,
Yeah, for sure.
anxiety. There's guys who go out there with erectile dysfunction that get disability for that.
Is that, I'm sorry, for this question, but, if a veteran is able to obtain veteran benefits, if, can they get that in addition to if they're already on, regular disability?
Yeah, they're entitled to it.
Even if they're on like social security disability, can they get? You have to show that your service caused the disability.
Yes.
So if someone has a disability from birth, but they happen to be in the service, they wouldn't get coverage for that. But anything that happened while they were serving would be
Yes.
covered.
They would be divorced. And there are some times where you have a 0% rating. Like I worked on a flight line with Harrier jets for a period of time. I have a 0% rating of hearing loss because anytime you work on a flight line, it's documented that you might have hearing loss. So over time, if I start to develop hearing loss, since I have it documented, you can obtain a percentage for that.
Because my spouse is a veteran and we bought our home that we're in now with this VA benefits. And I think we should try to obtain VA benefits because I think he has what I hear as a result. He has sleep, disorder, he can't sleep.
Okay.
His always having to be
Sure.
from a marine, so.
If he needs to talk to one of those reps, they will help him understand and get to.
And you can
Okay,
check with
better.
Mike and he can give you some more detailed information on that
Yeah.
specifically. I've never heard that.
I just
so.
think that there's benefits that he's.
Yeah.
getting off.
Not you.
And those resources know those benefits,
Yeah.
right?
Technically, every person, as they enlist or become commissioned, there's a fund started for them that basically guarantees them 100% 100% coverage disability wise for the rest of their life. Whether you use it or not, that's the difference. So there is just like with all social security, stuff like social security, stuff like that, it's all set aside for them already.
Did you send a VSO or what's the other?
DAV,
DA.
yep. It's like disabled, something, I don't know what it is, but.
Thank you.
Alrighty. Can we have 2 VA mortgages?
Yes. We're right.
You can.
That's no. I get asked that question almost more than any other question on VA.
Yep.
I already own a home or I bought a home in the past on VA. I can't use it. Man, that's bad info.
We used free.
Bad info for people who think they can only use it's one and done. No, and
Well, and-
so many people believe that. Many veterans believe it.
And you can have a current VA and a second one while that other one, you're still paying another one. Basically, we do a calculation to calculate bonus eligibility. Your guy, this is how my first experience with that. And I figured out what.
So the first thing we do is we get the COE that we talked about earlier and to show how much eligibility is tied to that
Yeah,
old home.
because it will tell us that he has used portion of his eligibility.
Because if someone assumes your mortgage, you don't get your eligibility back, just FYI, you put your money and all that, but your eligibility is still tied to that home until it's sold or paid off.
That's the deep dive portion right there.
That's the what?
That's deep dive stuff. That's
Yeah.
once again why what
Yeah, you
happens.
don't get your eligibility back until that's sold, so you still can get another VA loan. We just have to run a calculation to see, can you get that VA loan with no down payment, or now do you need to make a little down payment?
Does this also include if, the new builder loans that veterans can do?
Any house you could buy, if you have another house that's a VA and you have enough eligibility. Here's the thing, this rule was written a million years ago, because you're gonna laugh. If the new home is over $144,000, then you can get another loan. What home isn't over $144,000, you know? It's ridiculous. They might as well just say another home, you know? But if the new home price is over 144, then you can get a second. No.
USDA.
Wait, that's before we go off, just on VA. Any questions on VA? You're gonna have the same appraisal things you're gonna have on conventional. Okay, I mean, excuse me, FHA. You're gonna have a government appraisal on VA, but the thing that's different is we don't pick the appraiser for VA. On conventional, FHA and USDA, CrossCountry sends the appraiser. Now, we're not allowed to know who it is. It's a blind system. But the panel that they choose from is a panel that I set up. So I set up 5 people that I've worked with for 25 years and expect them to work with for me well, you know, just like we're going to work for you. I expect these people to work for me the same way.
Is that how every lender does it?
Yes, because on, yes, but on VA,
No,
VA sends the appraisers. Not us. We have no say in who they send. They've gotten a lot better with their appraiser list. Back when I, like in the early, like 2003, 2004, some of the guys on the VA couldn't even walk. I had a guy, he's since passed, he could not go upstairs. So we would get an assignment, look to see if it was a 2-story and then have to decline it because he couldn't walk up the stairs. He was 100 years old and real heavy and emphysema. And I was like, why is he on the panel? Why is he getting, he's just cost me all this time. Well, VA's made a lot of improvements. Number one being they now have a 10-day turn time that they have to follow. That's new. That didn't used to be there. New within the last 5 years or so. I don't know when. They used to be able to take 6, 7, 8, 10 weeks to get it to us, and there's nothing we can do. There's no recourse because they don't work for us. They work for the VA. Okay, so that is something that you have to think about. If a VA appraisal is going to come in low, VA does something they call the Tidewater Initiative. I don't know why it's called that. It's probably some law. They send us an email and say, oh, we're going to invoke the Tidewater Initiative on ABC Smith Street. And the first time you get it, you're like, what does that mean? Have you ever had one of those?
I have not. Thank you.
Okay, you have 2 days to dispute it. You have to give information, they'll dispute it, they'll use it, and then they get you the appraisal. So.
Is that for just value or can that be for required repairs as well?
No, if it's required repairs, you get no notice. It just comes in with required repairs.
Okay.
This is value only.
There's also required inspection items though for VA, correct?
There is. Yep,
Yep.
that's what I'm going to do. So on VA, you must have a WDI, a pest inspection. If box 3 is ever checked, the one that says damage, even if they put something like it's old, it doesn't really matter, whatever, doesn't matter. Box 3 is checked, and it's the box that says damage. You need a structural inspection. That's a downside to VA, okay? That's one of the cons. But you don't need to get an engineer to go out there. It's a home inspector.
The guy that marks the box can also
Yeah.
be the guy that.
The guy who does and all what they need to say is that, oh, the pest inspection, the damage that I've seen is not structural in nature. If it is, they got to fix it before you can close. And I had one that was, and they had to like do sister adjoint. And I don't even know what that means, but that's the words they use. Sister adjoint, took pictures, and it was fine. Okay. But you do have the mandatory pest inspection. If there's private well and water, you also have a mandatory water test. And it has to be the
if
full.
it's present.
It has to be the full test for both bacteria and solids. There's 2 different kinds of tests. It has to be the full government pan.
That's good to notate there. Because
Especially have to go to a lab instead of just one of those little, got it from Walmart,
Right.
you know.
That's right. And it has to
And it takes a
pass.
couple days. They have to let it sit for a couple
Yeah.
days.
It does, the best idea is just to have it done by the same person.
Just have it done, send it off,
Yeah,
bring it back. If it comes back, we'll give you a chance to remediate it before we send it in. We don't be like, no, you might have to, back in the day, they shocked the wells. They don't do that as much anymore. There's different, things, UV light, there's stuff to do. But you do have mandatory pest inspection and water inspection, not septic unless there's an issue.
You guys gonna end up talking about the needs for VA. Because I sent it through the group.
Yeah, okay.
Can't answer this.
Okay, so veteran borrowers, VA is a little bit weird in that, like, if, let's say Catherine and I wanted to buy a house together. We could buy a house together. We go conventional. We do whatever we want. We could buy a house together. Mike and I could buy a house together. Liz might not like it.
My trigger mount.
So there's no problem on other loan types other than VA, who goes on the deed, who's the borrowers on the loan. But on a VA loan, Mike's already said it. VA vet is your primary borrower. VA, the only borrowers allowed on a VA loan, the only ones are veteran and spouse, 2 veterans, veteran by himself. Okay, so if veteran and spouse and they're married, they can be both on the deed, they both can be on the loan. If you have a married veteran and he's the only one on the loan because his wife's credit's shoddy, she can be on the deed too. They're married, they can be on the deed even though she's not on the loan. But let's say veteran and fiance is not on the loan because they're not married. You're not allowed to do that. Can he put her on the deed? Yeah. Veteran and spouse, 2 vets, vet by himself. Okay. One of the things that I have done in my career, and I know it's happened twice, is had folks come in to get pre-approved and they were engaged. They went to use the VA. And their wedding was like, I just remember the wedding was in September, so this would have been earlier in the year, and I don't remember when it was, but they were getting married in September, and let's say I took the loan application in May. I was like, you can't use your VA, you're not married, and they didn't have money, and they wanted to use the VA, and they're like, no, I guess we're not gonna be able to buy until then, and I was like, go out to the JP and get married and get your marriage license. Don't tell any of your friends. Don't make it a big deal. Give us your marriage license and still get married in September and have your big party. And that's what they did. And they bought their house with VA. And I guess they lived happily ever after. I never went back and checked. But
Never
you
got
know,
finance for the.
but there are ways that you can work those things if people they wanted the VA loan or wanted to buy the house. And I've actually had it happen twice. So it you know, the date that wedding is set in the party doesn't necessarily mean their heart's set on getting married on that day. That's just the day it worked out. So yeah, you make the situation fit them if you have to. Yeah. Anything else on VA?
Just a quick question, for the funding fee, is that a percentage of the purchase price?
Yes.
The loan amount.
Yeah, it depends on how many times, it depends on eligibility or how many times you.
We have a chart. Okay, the VA has a chart for everything. And when we send you this and the C12345, we'll send you the chart as well. Or it depends if we're active duty or enlisted. That's the first thing. Okay, active duty gets it cheap. And reserve. Active duty gets it cheaper than guard or reserve. Okay, so if you served active duty, you get a cheaper funding fee than the guard or the reserve does. And if you've used it in the past, it's higher. So like if you've used it, you bought a home 10 years ago, you're buying a home now, it's 3.3% of your sales price if you're doing 100% financing or loan amount. So it's hefty.
Yeah, the first one's 2.15%.
Okay.
So
We'll send that chart out too.
yeah,
That's an easy little chart.
caveat on the chart and everything. I was gone for the last 5 days. I need to catch up on everything else this afternoon.
Yeah.
Tomorrow I have a VA appointment actually, and then after that, probably mid-afternoon, I'll be sending everything out, just so it's time.
Get it Wednesday or Thursday. That's fine. Yes, you can.
All right,
Yes.
what's,
USDA?
the red.
Wait, what does USDA stand for? We did, okay, let's go back. What's FHA?
Federal Housing Administration.
Once again,
Federal Housing Administration.
perfect. What's VA?
This like
Veteran
United
Affairs.
States-
Perfect. What's USDA?
United States.
Exactly. Okay. Yes. You're like Department of Agriculture on a mortgage? Yes. This loan for 100 years was called the farm home loan. So if you hear farm home, they're talking about USDA. Like, did you know it's called farm home? So I've taught you something as well as you taught me. So farm home, it's also called rural housing loan.
Yeah. And
All
when you-
those loans.
and when you see it at a state level, like through PHFA, it's called an RHS.
Which is rural housing. So rural housing, farm home, USDA, all the same thing.
But it is a bit of a red-headed stepchild when it comes to government loans. Well, you stepchild? Okay, so you're fine. It's just not talked about. Nobody's interested in it. nobody thinks it matters because I think they're talking about buying a farm, all that kind of stuff. And that's what one of the big points I want to kind of dispel a little bit because of what some of the stuff you just talked about. Minimum credit score is 620. I think either went up to 640 recently, or it might have went.
I think we
was
can't
640,
get-
went down to
It's 620, but we can't get anybody approved unless they're 6.
Oh, okay.
I mean, just that's experience talking. We've had them. We just cannot get them approved under 640.
And it was because of the actual, it was because of the score, or it was because of the other.
It's a little bit of everything, but we've just found all the ones that we've run, if it's under, that's, you know, it's not a scientific experiment.
Right.
I just know that I have not been able to get anybody approved under 640.
Gotcha.
This is the only other type of government loan, or well, only one that your non-veterans can receive 100% financing. So that is a big
The
positive.
biggest.
Yep.
That's why people want this loan.
Somebody read that out loud.
Is USDA only for farm/rural homes?
No,
Yay! Right answer.
USDA has target areas. That is the emphasis behind it all. It is a targeted area. Oftentimes it's rural. So,
The orange is the place where you can't get it, so everywhere else is eligible.
Hummelstown is eligible. Middletown is eligible. High Spire is eligible. Those are not rural areas. All of Perry County is eligible. That is a rural area. But I mean, I was shocked. In 2015, USDA opened up some areas that were not considered traditionally rural, like High Spire, which is absolutely not.
that's right.
Because they wanted to get financing available to people in those areas.
They are trying to get people to live in those areas. They're trying
Or
to bring
rest
people.
areas, so to speak, were greater needs, so they opened up some areas to make them eligible. But like back when, before this market was what it was, I had someone who said, I need this program because I don't have money. Seller could pay all my closing costs, I could put no money down, and I might probably get to this mortgage insurance, it's really cheap, it's 0.5.
By the price is higher,
What's that?
by the price is higher, I have the, was it cost?
Or whatever it might be, but yeah, but maybe, or a different market or whatever, okay? So we went to the maps and looked at where they could buy, so anytime a listing came up in like the Humboldt, that's how they shopped for a home. It's harder, more work for you, but that is something that you can show buyers with no money. They have to be first-time home buyers. That they can buy in those areas with no money down. You can also combine all these things with PHFA and get all your closing costs paid for by PHFA. So you can do it USDA, no money down, PHFA, pay all your closing costs to get in and see dollars. Same with VA.
city.
No, PHFA is anywhere in the state. They don't have areas. I'm just saying you can combine, this is rural only. It will not be the city. You showed a map, right? With you, you're not, all the cities are oranged out.
Yeah, and last night I was thinking in my head like some kind of like physical representation of showing PHFA with adding it with loan.
It's too much, I said.
Yeah, oftentimes people conflate PHFA and they just forget about, it's like someone, if you've ever learned how to drive manual, first time you learn how to drive manual, you forget how to drive a car in general. When it comes to PHFA, people forget about just loans in general. There's like PHFA, was that FHA? I don't know what the heck it is.
Or they think it's a loan type. It's not.
Yeah,
It's an investor who provides money.
you have the loan, and then oftentimes, there is a gap that we need to make that loan work. So we bring in PHFA assistance programs. The PHFA does have other programs, but we're gonna use one of their assistant programs like KFIT, KFlex, or KDate to bridge that gap to fill it. I was gonna use cups. and
That's a
water.
different seminar, but
Now
basically,
you lost me.
Yeah.
Oh, it's kind of like the college loan, and then you get like a grant or
Like a Pell Grant or
different
Yeah.
or whatever, right?
Yeah.
So within PHFA is not a loan type. So the first thing I do when we meet with your buyers is find out what loan type they qualify for. Are they a veteran? I said, are you a veteran? No, I said, no, we're not gonna talk about VA loans, so you're not a veteran. That leaves conventional, USDA, and FHA. We get the credit score. The credit score is awesome. They have a little bit of cash. I put them into conventional because conventional is a better product for most buyers. It really truly is. We're not trying to say these are better than conventional. They are options and they're not bad options. but conventional is still the cream of the crop if you can get conventional. Okay, so whether you're conventional, VA, FHA, or USDA, and the lender, we will have that figured out first. If you're a first-time home buyer, you also then can get benefits from the state for being a first-time home buyer. And that may be money to pay closing costs, or it might be a below market interest rate. Right now in conventional, it's 5.75. Okay, get 20% down and get a 5.75 interest rate from the state. Okay, so PHFA just provides money to us to help people get into homes. Okay, but the first thing, it's not a loan program. The first thing we got to pick out which loan they're getting, which is what we're talking about today. Does that make sense?
When we say first time buyers, anybody who has
Owned a home in the last
3 years.
3 years. And we're gonna check the date, the deed.
Yes, checking the deed is key. I had somebody who was doing everything to get first time home buyer. Title gets pulled, they're on a deed and they've been foreclosed on that home for like 7 or 8 years, but something happened. So definitely that is key.
We look at the deed to the date of transfer. And so sometimes it takes a while to get that deed recorded, but that is the date that we use.
Yeah.
Recordation date on the deed.
So I think one of the things that I didn't specifically call out for FHA does not have income limits. You can make as much money as you qualify for it, you can use it. Like a family I picked out.
Farmers.
So that is where USDA is a little bit different. And a lot of anything from the state and stuff like that, it may have an income limit, has some kind of limit somewhere. This is one of those things. It has an income limit. So it is a household income. So if you have 4 people living there and you might just have one person earning an income, you may have 2 people earning an income. You may have 3 people earning an income. They all need to be, all of their income needs to be accounted for.
So as an example, mom and dad live in the house, they both work, have 2 kids. Okay, so mom and dad are on the mortgage, we have their income verified, we're all good to go, they are under the income limits. But what they didn't tell us is that their grandma lives in the basement. That's why they bought the finished basement. Grandma lives in the basement, she gets Social Security of another $30,000 a year, 20, whatever she gets. That income, even though grandma's not on the mortgage, counts in the income limits.
That would count the same for each child.
No, under 18 does not count. You only have to put family members over the age of 18 on who earns income.
Okay. But say for that example, say they have over 4 people and they have 5 people with grandma, then their income limit has just increased. So.
And that limit is done by county. Each county in the state is different. Okay. I also have those charts at some point. I don't know if Mike does, but I have them all saved on my desktop. I update, they come out every year when the income limits change. So I have that. The maps, there's just an address that you go to. We are right now swamped because of the holiday and just trying to get things done. But when we get a minute, we can also send you the link just to go check the maps, which is really easy. Oh, is it? Okay, good.
So yeah.
Okay.
But so that is one con. You have to factor that in. And the way we do that is by taking tax transcripts. So it's just another element that we have to add to getting the sale.
It's a big deal because it can make you not qualify. It's good to know up front that anybody that lives in that house that's over 18, we're counting the income in the income limits.
Okay. With that, USDA, another downside would be closing times. These are going to be 60-day closings. We qualify, do everything we need to do to clear this loan. From there, it gets sent to the USDA itself. They go through a whole process. Once it goes to USDA, our hands are off of it. We have zero control. One thing that we all kind of know about the government, they don't operate efficiently. So it may take some time. So we recommend everybody to do a 60-day closing. And we let everyone know what's going on because it might add an element. If the government shuts down, guess what happens? One of 2 things. It's either going to operate, which would be great, or sometimes they shut down the USDA and they are not looking at any more loans And sometimes sellers can get upset because they'll tell you what.
And the difference between that and like FHA and VA is we have authority as a large lender with a lot of clout that we approve our underwriters loans for FHA and VA. USDA underwriters approve loans for USDA. So we can still operate in a government shutdown with FHA and VA.
It actually killed one of my deals.
So on USDA though, it is the strictest of all the loan types for their guidelines by far.
And I want to touch on that too, because a lot of people, they get so worked up about why. These are not for everybody. These are for those that maybe would not be able to traditionally get financing. So they have programs cut out for those that want to own a home, but have something in the way of not being able to do it. Just like if somebody's making $1 million a year or whatever, financing really should be easy for them. They're not taking these. This is government funds. You know what I mean? This is money that comes out of your and I paycheck every single time. So it is not for everybody. Has strict guides and requirements, so people aren't taking advantage of a system.
What you don't want to think or have the wrong impression, though, Mike said earlier about farms. There's an agent that works here, Christine Milne. Now she's Christine Miller. She's a dual agent. She works at the Department of Agriculture, actually. When she bought her home, I don't know, 15 years ago, she and I were working together. She was trying to buy a farm. She kept wanting to get this. I'm like, it's not for farms. You cannot buy a working farm with this loan. You cannot buy a working farm with any loan that we have other than a brokered out loan for a farm. Income producing farms are basically not financeable like traditional financing.
Right.
Exactly, but people think this is for farms. It is not. This is for residential real estate that is not a working farm, but might happen to be out in the country. Dover, there's so many rural places around here. Oh, Perry County. Yeah, there's just so many. It's like Gardner's, Boiling Springs, where I live. You know, there's just so many rural places, and it's a great loan, but it is difficult to qualify for. I mean, they are strict on their guidelines. They want credit to be good, and they want your income to be. They want in line and your debt to income ratio to be good. That your debt to income ratio, and this is the lowest of every loan we have. It's 29.43.
Yeah, that's great.
Okay. Correct.
We're almost done here. Last little bit of things here. I changed this last minute, so I put this at the end because all of these are kind of relevant for this. So we are going to use some of what we learned to identify some problems on some pictures here. So I had a bunch of pictures here of all different things that are throwing some kind of a red flag when you're touring a home. You should be calling it out and being aware that, hey, this is going to be a problem. First one I have here is, can anyone point out what is potentially missing in this picture?
Handrail.
Handrail. Can fall off the side of it, break your neck. No good. This is something I've seen in a home recently that was like a $500,000 house, and I think in the kitchen out of like all 6 outlets, 5 of them were like this. A listing agent could take an hour and put this back in the wall, put a plate on, and I would have to be my wife with this door. They weren't even interested in the house because they just saw this and they're like, you know what, this house probably wasn't taken care of. I don't even want to write an offer on this. It would take you an hour and less than $100 to fix all this.
Why?
You can get a GC to come and do that. I mean, you can do it, anybody can do it. It's not that hard to do. It's something that's very easy to address. This picture right here, we're looking at the third one in from the right, left. That is an oil tank in a basement.
What does it look like?
What is below it there is leaking oil. It does not necessarily always have to be a dripping puddle mess for it to be called out. In my own personal home, when I purchased, what's that?
Just the cameras. You're gonna do about that. It's great. Whenever you're pointing to them, there you go.
That one there does not always need to be leaking to be called out. On my personal VA loan, I had a disconnected oil tank, but it was half full. And the appraiser called it out that it needed to be removed for it to comply for the VA loan. So I had to drain and remove it for them to comply to be able to get the VA mortgage. because it has a chance of leaking. So if you see disconnected oil tank, check the level of it, or just make your buyer or seller aware. This may be something that we may want to remove ahead of time, or just let you know we may need to remove this to get this approved for financing. This final picture on the top here, that's a roof. What are we seeing in there that maybe we might want to call out?
Shingles.
Yep, it is missing shingles. Roofs are very, very important. They are kind of the top of whatever is going to secure the house. And when it comes to homeowners insurance, that's a big thing right now. So if there is shingles missing, that's something that an appraiser is going to call out and going to need to be fixed. So once again, looking at roofs, especially just in general, like government loans aside, as an agent, you should get very familiar of what a good roof looks like and an aged roof looks like. I know I've worked with Ryan's Roofing. That guy is great. I think 5-star maybe still a vendor in here. I don't know, no longer.
Nope.
Let me also add just on the roof thing is that it may pass appraisal and you think you're good to go. And then the insurance company sends the drones up, which they are doing now. They send the drone over the property and they look at the roof, which the appraiser didn't get up there. He's looking from ground level up. Now the insurance company sends the drone and says, oh, you have placed it because the insurance company said it needed to replace, not the lender, nothing to do with the mortgage, but for insurance, homeowners insurance. At that point, I would switch homeowners insurance companies and we would try and get you one through one of our vendors, but they are sending drones over roofs and looking at it.
Yeah, and is this just the primary residence, or is this also including outbuildings?
That's a good question.
They're changing one of the, you know how we talked about the painting? They're changing the outbuildings that they're no longer going to be included for termites and all that.
I had no idea.
They're changing that, yeah. Yep.
Yeah, good question. Coming back down here, this is a
Where did you get these? Are these from our files?
no.
Oh.
No. I was actually going to find listings, but I was like, that might also be like
Yeah, no,
not
okay.
good to do.
Yeah.
That's a level, and as you can see, you can see the literal glare and shadow of the bottom side of the level on the wood there. Your subfloor is bowed, so underneath this wooden LPV or real wood, I don't know what it is. There's going to be subfloor under there. It is bowed and sagged. That will be called out. That cannot be, because you could.
That's a safety issue.
Yep, you could fall through the floor.
Looks like actual wood.
So is buckled sidewalks up to the house, by the way.
Yeah, tripping.
That's a safety issue too, we've got to say on it. Check.
Right here, the next one. What do we see there? Some little critters. Those are some ants. And an infestation of anything. It doesn't always need to be termites to be a red flag for an appraiser. If it's an infestation of any bug, it can be a problem on an appraisal. Nicole has a connection on that.
Does anyone need the wood destroying insect inspector? My husband said.
Yep.
For who?
He has his own company. It's called Pest Control.
Yep. I say the one that he did for me, for the buyer, had ants. He laid down some quick treatment stuff for it while he was doing it and was cleared on wooden. He just saw a couple ants, but he literally laid down there. That's what a good pest control person is going to do. It takes care of the problem, but it doesn't always need to be termites.
Yeah, and if he goes out and does like a wood destroying insect inspection and he doesn't see any actual like wood destroying insects, but he sees other issues, he obviously won't write that on the report, but he'll let you know.
Let you know.
Yeah.
Hey, you have spiders all through your,
Yeah, like the one house, there was like a mouse hole where like a mouse could get in, and so let me know, like,
Yeah,
you know,
you're good. But
not on the report, but just so you know.
player, he knows
Patch that up.
what's going on.
Yeah.
Next one here is ripped up and torn carpet. Basically, there's no longer nothing protecting underneath of it. This is just an example.
You probably could not get that past a conventional appraisal either, just because it's such a safety issue. So all they have to do is tear that carpeting off and they would probably be fine on conventional because they're really not looking for looks, but that is so dangerous that I'm pretty sure that is enough.
Stop. And then the very last one, it is hard to see, but I kind of did it on purpose because they are hard to see in general. And I have a funny story about it, but that is a cracked window pane. That would also be another red flag. And it's something that, once again, if I was a listing agent, I'd want to get addressed before I have buyers go through, so they don't even have to start asking questions about the integrity of everything else in the house.
FHA and VA will call, cracked windows, broken windows as repairing.
But you're saying that they won't do it on outbuildings anymore?
Correct, that's what they're going for. They're not even gonna address outbuildings supposedly.
Oh, okay.
Funny story about this, and I kind of want to like wrap up with this in general. This is not word of law or anything like that. You guys need to be aware of all these things. You would think appraisers are out there, they're going to see this, write it down. It's not always the case. I worked with somebody at Faulkner. She got approved for FHA financing. I helped her move in and all that stuff. I'm on the 3rd floor. What do we find? We find knob and tube wiring, which I didn't even talk about. Knob and tube is going to be something that's going to be a red flag. Picture this as a wall. Window here, storm window in there, normal window here, no storm window there. You can stick your hand through there. A bird could come in there, an animal could come in there. Not a thing about it. So, not saying that you should like roll the dice, see what happens, but generally speaking, appraisers are not trying to kill deals. If it's egregious, they're gonna call it out. I've seen steps not get called out that we figured would need handrails. And that's kind of why I wanted to just finish on it. Once again, that's kind of just between you and I guess. But it's things you think, just being aware is the most important part. And that's what this whole thing is about.
Whether or not the appraiser calls something out, we don't have any control over that, right? If they see it and they think it's egregious, they'll probably put it on there. Could they miss something? Yes. Could they also think, oh, I've been working with Terri for 20 years and I don't want to make this deal hard. I'm just not going to write this down. Maybe they do that too, but that's not doing anybody any favors in the long run, because if there's problems, we should know. Now, what they're thinking is it might save the deal because you don't have to go back and renegotiate. So we don't know what the appraiser is going to put on there, but Mike has pointed out, these are all the guidelines and what they should point out. You as a listing agent should, if there's a couple little things that you can do to get the house into a position that you can accept FHA offers, you're gonna probably get a lot more offers on your house. We still are pre-approving people for FHA right now, okay? And now they gotta go find a house and 90% say cash in convention. And they don't have to. And maybe you're buying, these people are desperate. Maybe they'll pay $10,000 more because they can't find a house because they're FHA. I have one with Milne and Matt right now. And they cannot find a house and get an FHA contract accepted. Good buyers just can't get it, so if you can get your listings into a situation that maybe with just a few little tweaks or no tweaks at all and accept FHA, they're really not bad loans. Nor VA, I mean, USDA is tough. I mean, USDA is the toughest.
Yeah, there's a lot of string attached and caveats to it, but
if you're gonna learn 2 of these or 1 of these, start with VA. Because helping the veterans is everybody's priority. Many sellers who wouldn't accept an FHA might accept a VA just because they, like Mike said, they feel they're doing something good for their country, people who serve. So learn FHA, learn VA, and then once you have a little bit more capacity, then learn the USDA, because USDA is tough. And honestly, I haven't done a USDA in that closed in like 7 years. It's just not. A lot of that's market driven, and the fact that PHFA, their assistance today helps almost as much as you getting that USDA loan. So we haven't had to use it as much because when we send it to USDA, we lose control.
end of the day too, we're real estate professionals. These are all things that may come up at some point in your career, whether you're doing this a year, 2 years, 10 years, 20 years, 30 years. 40 years.
Yeah.
So it is all relevant. I feel like it's good for anybody who's been doing it for a little bit or a lot of it. So yeah.
And if you have any questions, you have a buyer that you are thinking about putting into the program, give Mike a call. You can call me as well, but Mike's more available for you these days. I'm on this side of my career instead of this side of my career. But, you know, I'm available always to answer questions, all the time for questions. But, you know, if you do have a buyer and you're thinking, man, this sounds like something like Mike was talking about, that they might be good for this product. Mike sits down and does buyer consults all the time, you know, so you can get in and even for yourself, just to get more comfortable to sit down and talk about it with a particular buyer and a particular property in mind. Sometimes when it's on paper and you're actually scratching out the numbers and doing the working, it's easier for you to get your head around it, you know, so. Okay, any questions on any of that? So we need to get you the PowerPoint. Do you? Write this down. I'm a big write this down person. I thought you had laughed at that. Write this down. Okay, so we need to get the PowerPoint. We need to get you the definition of the appraisal definitions, the C1 through C5 things, okay? We need to get the MIP charts to you, not the MIP, the funding fee chart. And was there something else somebody asked for? I thought there was a fourth thing.
C1, C5 stuff.
That was the first one. So appraisal definition,
The
well,
other
PowerPoint.
is in the slideshow.
What was it?
The link to.
The link to USDA is in
the
there.
slide.
Okay, so yeah, so we have,
I know I'm gonna send some
You just
flyers.
Google appraisal condition for appraisal condition ratings, it'll go C1 or C6.
yeah, so it tells you those. We have the PowerPoint link, the appraisal definition, the funding fee, and I guess that was it. If there's anything else that comes up, because what did I say? I had something that I had to dig through to get.
USDA.
Mhm. It was, I said, I have that all saved, but if I think of it, I'll just let you know. There's something else I had said about getting to you guys. I'll get it to Mike and
You guys either know Terry well or myself well.
we'll get it to you. Yeah, and it probably, it's not going to be tomorrow. It'd probably be Thursday. Okay, so if you have questions when you get it, just call us. We do a Zoom, we can do a sit down, we can do an over the phone, whatever it is you need. Thank you very much for coming. I'm
I
glad you
appreciate-
all came out. Sometimes we have one person, very disappointing. It's nice to see, you know, we earlier had a big group, so thanks so much. And let us know if you have any ideas for trainings, whatever you're interested in. We'd like to talk about what interests you, not necessarily just what interests us.
I got some. Oh, I bet.
There you go.
That stems from this guy over here. But yeah, I appreciate everyone being engaged. Honestly, like I do love teaching. I know Terry has an knack for teaching. But yeah, it feels good to engage with everybody. And it's crazy.
Yeah.
Oh, and 2 hours sleep. Yeah, we've been doing this, I feel like, for 2 hours too.
I'm at 7, so I'm good.
Thanks, everyone.
Thank you. Thank you, Mike.
Oh, yeah.
Very good
Thank you,
presentation.
Mike. Thank you, Terry, for these.
Oh, yeah. Where does
Lots
this go?
of picks.
Appreciate you guys making the trip.
Oh, absolutely. Yeah, it was great.
Good. I'm trying to.
I learned so much.
Yeah, whenever we were watching the gate time, the Arthur time, just kind of